This video is to replace Lecture 2 on the framework that unfortunately was disrupted today by events on campus. So please forgive any rough and readiness, and I'm going to try my very best to recreate the classroom environment as it would have been for you. Unfortunately, the interaction is lacking, but if you have any questions, please do send through an email or come and pop by and visit us so that we can solve the problems. I'll try to address issues that have come up in the classes we've had, that we have the least possible disruption and negative effect from all of this. The lecture today, we wanted to start by just following up on questions that we've received in terms of where does the framework fit into accounting? Where does it fit into your studies? Where does it fit in to what you're going to be doing in life one day? So there's various things, and perhaps pause for this video for a moment just to consider to yourself, what do you think? Where does the framework fit in? What is the point of the framework? What does it mean to you? Pause the video for a moment and consider that for yourself. The framework's got two or three purposes. The first one that we can consider is that in setting the standards, this is probably the most obvious one. The ISB uses the frameworks and the concepts therein to inform the decisions it makes while it's setting a standard on a specific economic event. So if, for example, the ISB needs to set the standard on property, plant and equipment, and they need to make decisions on how to account for that, they'll definitely be informed by what the asset definition is. They'll have a look at measurement bases to do with the assets. So it guides the ISB, and the reason it does this is because the board members are appointed for a 4-year term, renewable once, so they can maybe do 8 years. And then people on the board change. So to make sure all those people are going in the same direction and using the same framework, we have the conceptual framework that they can make consistent decisions as board members change. Also remember, when we spoke about in the first lecture, what's the objective of financial reporting? We can all have our own objective for financial reporting. But when we are preparing IFRS financial reports, they need to be in line with the IFRS's objective. That was agreed through due process many years ago. So it helps board members who come from very different countries and have very different views of the world focus their attention on what is the objective in this instance, regardless of what their personal view is. That may influence them later on if they revise the objective. But at the moment we go, this is the objective of IFRS. The framework is based on that, and that helps us set the standards, and it helps us keep us in line with what we're doing and keep us focused on a specific goal. That is not haphazard and all over the show. The question that then comes to mind is, given all of this, what is the point of this to me as a preparer, or to you as an accounting student? Why would you want to know about the framework? Maybe take a moment to think about that again, and pause the video and just think about it before carrying on and listening to my comments on that. The thing is, the framework has informed the standard setting. So if you are studying a standard, whether you're a student or whether you're a practitioner one day and you're trying to interpret something and you're having difficulty with it, step back for a moment and have a look at what you're challenged by and try and think about it conceptually, because what you're looking at is more likely than not being set based on concepts informed in the framework. So see if that will help you understand it better and what the ISB was trying to achieve by whatever you're faced with. So the framework helps you understand the standards. Then remember also that IAS 8 hierarchy, which you will study later on during the year, but that hierarchy, that tells you that if you don't have a standard, you need to go to the framework. Strictly speaking, you should look for a similar standard first, but for the purposes of this discussion, let's go and say there is no standard on the particular economic event you want to account for. So think of the Volkswagen scandal we've been doing the case study on in class. That economic event, could you find a standard that would account for it? The answer, 100% right, is there probably is standards, but we assume that there isn't one. So in the event that there isn't a standard, then you need to almost take the role of the ISB and set your own principles and rules for accounting for this economic event. And What's hoped by that is that if you are informed by the same document that informs the ISB in their standard setting, what you come up with should be very similar to what they would have come up with. Probably not exactly the same. We're all biased in different ways, and it's not a thorough process. Although you can consult with colleagues in similar industries, with other CAs, and get their advice, and you should be able to come up with a fair idea of how to account for this economic event that could be regarded as generally accepted accounting practice, even though there is no prescriptions for how to account for it. So hopefully you're getting the picture in your head that the framework is central to the IFRS world. It is not a standard, that we must be clear on. It is not a standard. All of the other standards overrule the framework, but they're all braced in it. So what you're going to even see in your follow-up lectures next week on IS1 is a lot of what you have learnt in the framework is going to be repeated in IS1. And the reason for that is to take some of those things like going concern and turn them into part of IFRS. So you will see some duplication, but you could argue that the standard is based on the framework and that's how it should be. The question was then asked in the groups that could have class today. The question did come up both times that they just wanted now a better understanding of how the framework plugged into accounting. I think a very nice way to try and understand, and it's a way that works quite well for me, and it seems to have worked for many students as well, just to understand how the framework fits into accounting and give it an accounting context, is to think of a general journal entry. And what you need to do is accounting starts with an economic event. That is the starting point of the whole accounting process. And then say to yourself, okay, what element do we have in accounting? What do we have here? Is it an asset? Is it an expense? On the credit side, is it equity? Is it a liability? Is it income? So go through your element definitions and work out what are we considering here. That'll be your first call. And from that, if you go to your recognition criteria paragraph, your recognition criteria paragraph says an entity, element that meets the definition. So sort the definition out, do I have an element? Then it's going into the recognition criteria of reliably measurable, probability of economic benefits flowing. Apply that recognition criteria. If the recognition criteria and the definition can all be met, then that can trigger the recording process and you can actually do a general journal and account for it in your statement of financial position, your comprehensive income, whatever the case may be. So you look at your elements, look at your recognition criteria. If you can do a journal entry, your next step is to say, all right, we can recognize something, but now at what amount? And if we disregard all the accounting standards that exist, and you've seen in previous videos that there's a lot of different measurement bases, and that's not ideal. But ignoring those, coming back to the framework, and here is the cause of all those differences. There's a lot of different criteria that are just listed in the framework. The framework doesn't offer any guidance as to which one is preferable in any particular circumstance or overall. So at this stage, if you just had the framework as your frame of reference, you could pick and choose from those. But what would inform that decision? Your qualitative characteristics. Fair value, current cost, historical cost, what would you go with? Well, what's going to give you relevant information? What's going to faithfully represent the item you're reporting on? All those enhancing characteristics. How will you achieve those? You need to use that to inform your decision because you are trying to give, remember, useful information to specific users. So using your element definition, you decide on recognition, get your measurement. Making all of those, though, that entire process is surrounded by what is my purpose? I'm trying to provide useful information to specific people, investors, lenders, and creditors. What would they need to know? And can I provide relevant information to them? Can I faithfully represent what it is that economic event all about? If you cannot meet the recognition criteria, you may have met the elements definition, so you may have an asset, but you may not have the recognition criteria, so you cannot do the journal entry. Now you need to think, well, can I turn this story into words and tell the story in the notes? Can I have a narrative on this? And in deciding that, again, it's back to that overarching thing. I want to give useful information to my users who are a specific group that the ISB is agreed on. We don't get distracted by our own views on this. We are doing IFRS reports, and the whole time applying, getting useful information that's relevant and faithfully represented. So I hope having a look at a journal will give you a little bit of structure in your understanding of how the framework influences accounting.